This is Trepp Wire Week in Review for week ending September 18th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS commercial real estate and CLO markets. I'm with our experts Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. This week, a round of new economic data highlights the soft pockets in the recovery. August retail sales increased 0.6%, which was lower than expected. Housing starts were also a disappointment, with a decline of 5.1% last month, and much of that was due to a big slowdown in multifamily housing. Initial jobless claims made a slight improvement from the prior week, with 860,000 new claims, and the Fed projected keeping interest rates low for 3 years and targeting inflation around 2%. Wall Street had another volatile week, suggesting a loss of positive momentum. Manus, Fed Chair Powell was asked specifically about plans to offer relief to CRE borrowers, and the answer was, in essence, a polite no.
Well, I guess we're not surprised, and probably our listeners were not surprised either. We had been mentioning before that in earlier recordings that the Fed is not in the business of handing out cash or checks or anything else. You know, the last stimulus that came through in the spring was an act of Congress, and that was done to put the $1,200 checks into workers' hands. We have another stimulus working its way through. But as we mentioned, and some of our experts have mentioned, it's not something that is permissible from the Fed. And that's why when we saw the HOPES Act being pushed by Representative Van Taylor and others, it was built in such a way that borrowers could take on cash in return for preferred equity, and that would be the vehicle by which hotel owners and retail property owners could get cash. So it really wasn't a big surprise to those in the industry, although I think the bigger shock was to those that are kind of on the periphery of the business, who are hoping that Powell and the Fed would reveal another bazooka. And when there wasn't a bazooka out there to display or march up Pennsylvania Avenue or, fire off, I think that led to some of the stock market sell-off this week. There was a little bit of air coming out of the balloon, so to speak. So even though there was this, I guess it would be 3-year hiatus forthcoming on interest rate hikes, because they said that there would be no hikes until the end of 2023, that wasn't enough really to get anybody going. And now with the stimulus seeming so bogged down in Washington, I think that the market is a little bit on the treadmill waiting for something else to happen.
Well, I think the Fed watching equity markets, or all markets, are so weirdly bipolar, because in 2012, I remember saying bad news is good news, right? Because bad news means the Fed will keep buying, keep the quantitative easing flowing. Now, bad news is bad news when the Fed comes out and says they're going to keep rates low for 3 more years, because we're happy when they keep rates low, but we're not happy when they say they're going to keep rates low for 3 years, because that indicates that the Fed doesn't believe that there's going to be real economic growth for 3 years. Right. So there's kind of this bipolar reaction. If they had said, we're going to keep rates low for the foreseeable future, I think that would have been a happier response from the markets.
I totally agree. And I think that just like us laymen who just look at the tea leaves and the data and so forth and try to make head or tail of it, the Fed has to be looking at this the same way. Retail sales were down, which is disappointing, but property prices, home prices, and so forth, asset prices have been up, sometimes dramatically. So it's really hard to get your arms around not only where is the economy really sitting at this point. When you throw in things like, when will we have a vaccine? How quickly will people open? How confident people will be? All of that is just so hazy right now that I almost think that any prediction they make has to be taken with the same grain of salt that we offer up in our podcasts.
Slightly larger grain of salt. I think we have smaller grains of salt in this podcast.
You mean we have more credibility? Is that where you're taking us?
I think so.
But just talking about the data in one narrow area, this week, one piece of data said home builder confidence was at an all-time high. It just blew by estimates this month. Last month was an all-time high. This month was another all-time high. So that part of the market is incredibly bullish, yet today, housing starts and new permitting disappointed. So it just seems like with every green shoot, there's another piece of data right behind it, which is kind of like the weed killer. Like it's spraying on that green shoot, and they're just spraying just a little too much weed killer on it just to douse our enthusiasm. So, I wish we had more clarity on the whole thing, but we'd be lying if we did.
Let's move on to Trepp has about 50% or so of its own data reported for delinquency updates. Manus, what does that look like?
A lot to see so far. As you said, we're about 50% of the way through. We're recording this the week of September 13th. So by the end of this week, early next week, we'll be putting out on our Trepp Wire the first look at the numbers as we see them. At that point, we should be more like 80 or 90% complete. At the moment, we see a very, very slight downtick in the percentage of loans 30 days delinquent. It's almost not worth mentioning at this point. That could change 20 basis points either up or down, given that we're only halfway through the reporting cycle at this point. But what we saw, just to remind everybody, a big spike in delinquencies in May and June. In July and August, we saw a lowering of the delinquency rate, largely because of forbearances being granted, hotel owners and others using reserves to keep loans current. So even though they were technically current, they weren't necessarily truly current in the sense of a borrower writing a check or wiring in money each month. We estimated that the true delinquency rate, if you backed out forborne loans, would be closer to 11%. Now that perhaps we're getting to the end of the forbearance cycle, we've seen a lot of forbearances May, June, July, August, that we may see that relief ending, or at least not as many new forbearances being granted at this point. And that may mean that this leveling off we're seeing right now could be headed north in coming months, although we don't expect it to be dramatic. Other points of data of interest, we've seen a big spike in the special servicing number with 50% reporting. Last month, we were at a little over 10%. Right now, that's looking to be 11.7%, which would go hand in hand with, if you're thinking special servicing is going up and that's a reflection of more delinquencies forthcoming, that would go hand in hand with what I said before, that now that we're kind of getting to the end of the forbearance cycle, we could start seeing that delinquency number go up. Other areas of note, the special servicing numbers for lodging and retail just continue to skyrocket. Lodging appears to be headed for about a 3.5% jump this month in the percentage of loans in special servicing, which would put it at about 28%. On the retail side right now, we're looking at an increase of special servicing numbers of more than 4%. And that's what's really driving that 170 basis point or so increase in the overall special servicing number thus far in September.
So to me, I feel like, for many, many years, we've put out the delinquency report every month. And that's kind of the number that everybody watches, just like, the unemployment rate for the broader economy. We look at the delinquency rate. I think during this whole COVID time that the special servicing number is probably more useful, right? You said it, a loan goes 30, 60, 90, it falls into the delinquency bucket, gets a forbearance. leaves the delinquency bucket, but remains in the special servicing bucket most of the time. So I think that's probably the number that people should be paying attention to. And I'm looking at the chart here on my end in our kind of BI tool, where we can kind of look at all the data all in one place. And the lodging is a hockey stick, and the retail is a slightly less curved hockey stick right underneath it. And I see the same thing. There's no let up there. I mean, every other asset class, it seems, has flattened out or slightly decreased on the special servicing chart. But those just keep going up and up. I mean, at this pace, at this rate, we could be at 50% in 3 or 4 or 5 months for lodging and retail, that is. In catching up on emails, I got a question or two from some clients about, the future outlook of multifamily, and how, there are some outlets calling for, let's say, less of a decline in multifamily this time around versus the last time, versus the great financial crisis. And for me, my response generally was, it's, first of all, nobody knows what's going to happen, right? But who are we to say that, the economy that's been generally shut down for 6+ months, especially in the kind of middle to lower income service sectors, how is it possible that we say that this is not going to affect multifamily, negatively, similar to the last downturn, right? I mean, I understand there's so much investment capital out there, and you got Fannie and Freddie forbearance agreements, and you have eviction moratorium and things like that. But just on the economics of the thing, there have to be a lot of people who are feeling the pain right now, especially if there's not another bill passed. So, I mean, maybe prices don't decline, as much as the last time around, because there's just so much capital there to hold up prices on the investment side. But I have to think that NOIs are going to get hit pretty well, right? Especially in the B- to C class category.
Your remarks just remind me of the last crisis, and
everybody's saying, "Oh, it's not going to be that bad." Right?
Well, I was just thinking of something that was just kind of off the beaten path. That the first sign that there were real problems in the last crisis was that back in the day, everybody was pretty busy, and you ended up getting maybe a 638 train at a Metro North or at a Grand Central, or a 704 or the 731. And those trains would be packed with guys in suit and ties, businessmen, et cetera. Everybody was busy. If you ever got on the 515 train, if you had to go home for that soul crushing holiday 4th grade concert, and you had to make that 515 train, it was usually empty, right? The first sign of things going bad was that 515 train started getting packed. Nobody had anything to do. Nobody was lending. Nobody was doing deals. As soon as 5 o'clock came, people were getting on the train and going home because there was nothing else to do. In this crisis, now that I spent part of my time in Westchester, but part of my time in South Carolina, the big tell for me was I'd be walking the dog and I'd watch the train go by every night, and there'd be 4 people on the train to Scarsdale. Mm-hmm. And, that's the tell for me. When I'm looking out my window and I start seeing 40 people on each car and not 4 people, that'll be the sign that, we're ready to start seeing a comeback.
That's the Manus Train Index, which I think we've referred to.
So I just want to mark this moment in history, because we have officially reached maturity as a podcast group, because we've had the first repeat Manus story, right? First of many, but the first.
The soul crushing 4th grade concert, is that
the train index?
Oh, I got you.
We're familiar with the train index.
Now, about a year from now, we'll hear the cream donut story again, and that's when we know we've really entered our kind of our last and final explosive phase.
We would jump the shark then.
Literally,
well, not
explosive.
Only is Joe PTO this week, but our producer Keegan is PTO today. I'm a little worried about Keegan because I haven't seen him since Sunday when Tom Brady donned the Buccaneers jersey. I'm afraid, he's
in mourning.
monking in Tibet somewhere, like he's taken on a vow of silence and poverty, and he's in Tibet somewhere. But we don't have him to keep us honest. Normally, if I'm talking too long or I'm repeating myself, he'll give me the cut sign.
Okay, we had a couple of tidbits in retail news that wanted to get some conversation on. One was Amazon, and speaking of soul crushing, continues to batter struggling department stores with the launch of luxury fashion shops on its mobile app with items from Oscar de la Renta. Now, Manus, I don't know if you know what Oscar de la Renta is. You may not have any of those in your closet.
He's a boxer, right?
Close. But to me, I'm not sure I see how Amazon's going to pivot to luxury items.
I'm not sure I'm the best guy to comment on this. As those closest to me know, my best days are when I could find 3 machine washable suits for $199, right? That's my vibe. I'm not a, $2,000 suit guy. I'm still wearing the same belt that I wore, when I got out of college. That's just the way I roll. I'm not a big Amazon user. I'd say I'm kind of, Walmart, Target,
Kohl's,
PBRs, AM radio, no air conditioning,
No frills.
no frills.
and khaki pants from Kohl's. I would say that I'm lucky when I find 2 socks that are matching. But I would say here that if you are the luxury brands, I think you're getting in bed with a freaking shark. I think that before you know it, I mean, Amazon. There's been many articles written about this already. Amazon is killing branding in general, right? Now, I don't go to the store to seek out my, Hanes underwear or my, whatever, my Nike shoes, or maybe I do my Nike shoes, but the t-shirts that I'm buying or the polo shirts that I'm buying or the button-down shirts that I'm buying, now I just go on Amazon and I type in, cotton t-shirt, and you know what comes up? Amazon Basics cotton t-shirt, $10, right? Golf shorts, Amazon Basics golf shorts, $15, just cheap. And the only thing that this can do is, over the long run, is drive down the prices of luxury goods, which then make them not luxury. So I would be really, really careful if I was, Jimmy Choo or whatever, because I feel like, before too long, you're going to type in Jimmy Choo on Amazon, and there's going to be a Jimmy Choo shoe about 47 items down the list, and the first 46 items are going to be Amazon Basics or Jimmy Choo knockoff or whatever, and they're all going to be $40 and not whatever $400. Or Martha, you can tell me how much Jimmy Choos are, but I just and also I'm not sure, because I'm not really a luxury goods purchaser per se, but is part of purchasing really expensive things that are only expensive because of the brand, is part of the enjoyment of that going to the store and being treated like royalty, and being waited on, and having someone bring you a cold bottle of Perrier and everything like that, and walking out with the bag, right? Like I walked out with my little blue box and my little blue bag, buying something for my wife. Is that part of the satisfaction? And do you lose that when you're buying it on Amazon? I would think yes. So anyway, but then again, I mean, if no one's showing up to the malls, then these guys have to try to make some money somehow, I guess.
And if we look at some of the headlines from overseas, our friend Vivek, who also happens to run our London office out there, always has good updates for us, Joe.
So there were two stories that Vivek had highlighted that were interesting. One was there's something called the Eat Out to Help Out scheme, which I guess in the UK, scheme doesn't have such a negative connotation, but it's a program basically where the government is subsidizing dinners if you go out to eat Monday through Wednesday. So essentially they're trying to get people to go to restaurants and, support the local economy. But the funny part of it was that it totally submarined August's inflation numbers in the UK. If I bring up the thing here, the restaurants and hotels section change between July and August in percentage points of inflation was almost minus 50 basis points when everything else was relatively flat. There were a few things that were negative, a few things positive. But this minus 50 basis points on such a large portion of the economy actually caused inflation to be near zero, which kind of had people scratching their heads like, what's going on here? And then they realized, well, it's because everybody's taken basically 10 pounds, and that's money, 10 pounds off of their restaurant bill when they go out to eat. So, it's funny because we have all this stuff going on in New York about restaurants reopening at 25% capacity, and Yelp saying that 60% of businesses are not going to reopen, and all these other stories. And in jolly old London town, you have a nice eat out to help out scheme, helping out the restaurants. The number 2 was New Look, which is a British global fashion retailer. They've been going through some debt issues, and their creditors approved a CVA, which is a company voluntary arrangement. Don't quote me on this, but I assume it's kind of like a Chapter 11 settlement coming out of bankruptcy type of thing, saving it from collapse and protecting 11,000 jobs. I thought the most important or interesting part of this was the CVA entails a plan to switch more than 400 of its UK stores. So it's kind of a fast fashion kind of, I guess, mid-tier, not expensive, not cheap type place over there. They are going to transition 400 of their stores to a turnover-based rental model.
Let's turn to office. First, some European office news. It seems investors are looking at London a little closer now that overseas travel has been restricted.
Yeah, I think just some bullet points from the London office is that, post-Brexit, there was a lot of uncertainty, right? And I think that office prices, real estate prices in general were, negatively impacted by that. But it sounds like there is a feeling that at this point, with nobody traveling anywhere and a lot less fluidity of people, leaving the UK, going to Europe and coming back and so on, that there is a little bit more demand building up on the office side in the UK and in London in particular. So, I mean, I guess bad reason, but good outcome for them.
And on the US side, we had fits and starts on office news this week. On the upside, Bill Rudin, who's the CEO and co-chair of Rudin Management, said they had their best month in July when you look back 6 months with 2.3 million of square feet of leasing. So that was a positive. And given all of the negative news, he was very optimistic that people want to live and work in New York City and will eventually come back.
It's a mixed bag, like a lot of other data points we're seeing. On the negative side, every day you see another company that wants to shed, 50,000, 100,000, 500,000 square feet. There seems to be a really sizable inventory of sublease space right now. This week, we'll be writing about it in Trepp Wire at some point. Cars.com wanted to give up 50,000 square feet of its space in Chicago. It is the top tenant behind 300 South Riverside, I believe, which backs $167 million CMBS loan. It's not a big deal. Their lease is in place till 2031, but it just adds to this inventory, which will make it harder for people to complete new projects, to fill up places where tenants are wanting. It'll put downward pressure on the market in terms of, price per square foot. Getting outside, the major markets, we saw, yesterday, and we'll be writing about it in Trepp Wire on Friday morning, that Fifth Third announced that it would be reducing its office footprint by 20%. I think the Cincinnati Business Courier wrote about that. One of the properties that they're going to be leaving altogether is 580 Walnut. It has a really sizable exposure to Fifth Third, 180,000 square feet, 80% of the space. Fortunately, the Fifth Third lease is in place for the most part until 2025. I couldn't find any evidence of a termination option, but that is a $33 million CMBS loan for which physical occupancy will be dropping sometime later this year or next year, well below what it is now, and represents a loan that has to be footnoted by CMBS investors, right? It is a concern and potentially a problem waiting to happen depending on how the economy revives.
Well, a couple of other articles this week. I have to applaud Jamie Dimon at JP Morgan for trying to get people back in the damn office. I think September 21st was the day that he was saying traders have to be back in the office, barring health issues or childcare responsibilities. Then of course you get the obligatory article that 2 days later, which said, JP Morgan sending some employees home because an employee tested positive for COVID. I mean, I just don't know where the line is here. I really, it's hard I can opine all day on these things, but I am not qualified to tell you, hey, you should come to the office, even though Bill 5 rows over from you happened to test positive, 2 days ago or a week ago. I just don't know what makes the most sense from a humanity perspective. But, I just think they're really, they're trying, right? And I think that we have to try, to get back to normal, or at least get back to some semblance of normal. Goldman Sachs had the same story last week, which is they're trying to get people back on a rotational basis. It's the only way that, things get back to any sort of normal. It's the only way that restaurants in anywhere, but especially in kind of large cities, are going to have any chance of surviving. It's the only way that, the deli cart guy or the coffee cart guy or whoever it is, like everybody that relies upon the economy to be functioning as normal is dying for this to happen, right? So I do think that it was somewhat surprising, but maybe not so much, because I think JP Morgan is such a well thought of an institution that they're kind of taking somewhat of a lead on this, I think is great. Not that I'm dying to get back to the office anytime soon and get on subways or anything like that. So I'm torn, right? I think everybody is torn. Hey, I'm doing my job fairly well from home. Why do I have to be in a rush to get back on that train that Manus always talks about and increase Manus's train index?
It's such a personal decision, right? Only you know what your health story is, what your family story is, and so forth. And maybe the word is not ordering people back, but it's encouraging people back and telling, big firms especially, where you have several floors and so forth, we're going to have an open office. There's going to be a doorman here. There's going to be security. Anybody who wants to be here can be here. We're going to make it safe. We're going to have people spread out. And that way, people that are healthy, maybe they don't have childcare demands, that don't feel like they're at an in-risk or at-risk category, can start making their way back. Maybe they start moving back into their New York City apartments, and slowly but surely they represent kind of the point of the spear, so to speak. But I think to order everybody back may not be the right strategy as much as it is to encourage people and, start with the right demographic.
Right. Well, get all these, Martha's going to bring us to our next point, which is get all these unproductive work from home millennials into the office so that they'll actually do their damn work on Mondays and Fridays.
Is that what I said? I didn't say that.
Well, there was a story that came out today that was quoting a company called Brivo, Brivo, a company that provides access control systems for workplaces. And it's kind of funny. This is just a broader thing. Like every company in the world is trying to become a data company, right? Even companies that sell, the swipe card entry systems to office buildings, now they're coming out with their releases of their data, and they're probably going to try and sell that to somebody. So that data exhaust world is really growing, and we see it all the time. But anyway, the point of the story was that they're looking at quote unquote unlocks, which is every kind of key card swipe to get in or out of the office. And in late August, those unlocks were down 51% from the end of February. And that was for office buildings. Now, by comparison, manufacturing warehouse locations and retails were down, I think it was somewhere around 30%. So it makes sense, right? Because in offices, you have more workers that can work from home, whereas obviously manufacturing and retail, you need people there. But if you look at the breakdowns by city, New York is more like they're down to 40% of the level of where they were before. Chicago looks like around 50%. San Francisco is even lower than New York. I remember San Francisco was the first one to do a stay-at-home order before New York did. So they're all staying home, all those tech bros working from home. Miami's about half. Los Angeles, there's a lot of people back in the office. Seems like around 60-ish% are back. Maybe that's due to the fact that most people can drive to the office. That was the other part of the kind of JP Morgan / not just JP Morgan, but all office workers. It's one thing to ask them to come back to the office, which is a controlled environment where you can have, all sorts of sanitized stations, and you can do contact tracing and everything else. But when you're asking people to come back to the office, which means they have to get on a Metro North train or an LIRR train, or God forbid, a New Jersey Transit train, and then get on a subway or a bus or whatever it may be. It's just really hard to, like you said, man, is force people to take that journey.
I've never been one to lay down ultimatums, especially with my wife, but I did have one shortly after we got married, and that was, I will not live in a place where I have to take a bus to work. I said, it's out of the question. I'm not doing the bus thing. So I think it's the only one I ever had, but it was passionate, well delivered, organized, well thought out, and ultimately successful.
Way to stick with your principles, but I will tell you, the buses from New Jersey to New York were civilized when you compared it to other forms of transportation.
Well, there's more than one road into New York from New Jersey. There's only one train track from New Jersey into New York, and it's very often broken.
I would rather ride a burro 20 miles than be on a bus.
When you say burro, you mean like a donkey?
Yeah,
like Don Quixote on his way to the office.
Oh boy. All right. Let's move on to the shout outs of the week. Manus, you have a few, I'm sure.
We do. SN pinged us. He was interested in some of our modification thoughts, which we're grateful and happy to circulate around. For those that missed that podcast, we put out an offer that allowed people to ask us to send them an example of what a modification template looked like for a modified loan. So we have a couple of those. If you're interested in that, we will email them to you so that you could educate yourself on that. So SN, thank you for listening. KS also said he liked the educational segments, and we're going to do a couple based on his recommendations in the future, but we'll leave you in suspense. A Twitter person, I don't know if it's a man or a woman, Sakari, included us in his list of the best financial podcasts. We're humbled to be in the list. There were some really impressive names on that list, and really humbled to be part of something that he thinks was worthy of mentioning. So thank you to him or her. And then also AS, who underscored that we built the city on rock and roll as the worst song of all time. For those of you that missed it, we did a little riff a couple weeks ago on the worst songs of all time. So AS joins Steel City Dave with a vote for that Jefferson Starship song, which I don't hate nearly as much as they do. There are far worse songs to me, but not that good either.
Well, we also had Lucius. Now, I'm going to say people's names because I don't know why you just do initials, but I think that's your like radio, call sign. You just do initials. But Lucius, who's a very good friend of mine, had some additional submissions for our worst of the worst playlist, which includes Meatloaf's. I was going to say Meatballs. Meatloaf's "I Won't Do That," which I think is crazy. I would do anything for love. I think that's a great song. And Rupert Holmes, quote unquote, "That Pina Colada Song."
I think it's called Escape, but everybody knows it as That Pina Colada Song. And you know,
Truly terrible song. I have to agree with Lucius.
Is that if you like pina coladas and getting caught in the rain?
That's it. See what I mean? That's how you know it.
Right.
Yes. And Johnny.
The glorification of two people wanting to cheat on each other.
Yeah. Well, and they find each other. Isn't that perfect?
I guess I've never really listened that hard. I guess
they deserve each other, right?
Really listened that hard to the lyrics.
Last shout out goes to John H. from Dallas, and then we'll move on to the deal of the week.
Got a couple deals of the week.
Deal of the week.
This one was from Real Estate Business Online. I like this one a lot. It has a lot of different tentacles to it. Bloomingdale's Furniture is taking 25,000 square feet in the Samania Mall in Westbury, New York. That's on Long Island. They're going to be joining that roster of tenants in 2021. Matthew Cucker and Jordan Baruch of Colliers represented the landlord, which is the Lesso Group. Brian Schuster represented, he's of Ripco Real Estate. He represented Bloomingdale's. What made this interesting to me, aside from the fact that it's a retail takeover of space, which is just wonderful in this market, any of that is great, is that the Samania Mall used to be called, and I'm looking for The Source. The Source.
Oh, The Source, which was in CMAT 1999 P1 or something, right?
That is just way too much knowledge in your mind to have pulled that out. It certainly is. That property once backed a $125 million loan that took an $83 million loss on a 1999 deal, really star-crossed in terms of its tenant base. It had Fortunoff, Chapter 11, and liquidated. Circuit City, same thing, and Stephen Barry's among its tenants. So it got really wiped out hard. The Lesso Group came in and purchased it for $92 million a couple of years ago, have returned it to its lustrous state, and we're happy to report that they are our number one deal of the week by adding Bloomingdale's Furniture this month.
Almost as wild of a story as Ohika Castle, which we'll have to cover on another episode at some point.
Sure. But it is something I hadn't thought about this before, that furniture sellers probably are not a bad place to be in the suburbs right now. Westbury is in Nassau County, not far from the Long Island Coliseum where the Islanders play. Tons of people there. There must be a red hot real estate market right now as people try to get out of New York City. So furniture sellers there are probably doing pretty well. The second one came via BizNow. Nitya Capital acquired the Chasewood Tech Park in Houston. It's 92% leased, a diverse tenant base, some financial firms, tech, healthcare. GenCap was the seller. They were repped by Rick Goings and Ethan Goldberg of JLL. Morgan Stanley provided a $46 million loan, for which a $30 million piece has already found its way into a new CMBS deal. So if you've listened to me long enough, I like to focus on the positive, the fact that there's new lending going on and new CMBS deals coming to market with new post-COVID lending going on is wonderful. JLL's John Ream and Laura Sellingsblow, I hope, or blah, I'm not quite sure. I'm sorry if I mispronounced that, repped on the financing efforts. So great news on those.
Are there any real estate brokers out there named like John Smith? All right.
Not that Manus can pronounce.
Yeah, it's.
I guess no John Smiths are doing any deals that are falling into the deal
I
of
would
the
even
week.
struggle with John Smith. I'm just
That's what I
Smythe?
said.
when it
Smithy?
comes to names,
Smith?
just
So we had a trading alert this week highlighting the first case that we've seen of a loan deferral with no advancing. Manus, walk us through the details of this and what it means.
Well, this is quite interesting. We'll call this, our educational segment of the week. The property at hand and the loan at hand is Crocker Park. It is a big mixed-use complex in Westlake, Ohio. It has a lot of multifamily, but the multifamily doesn't back the loan. It's not part of the collateral. The collateral contains 80 retail tenants, including a Dick's Sporting Goods, and 18 office tenants. The loan is $140 million. The borrowers were granted a 12-month deferral. And if you recall one of our earlier podcasts, very early podcasts with the Henry Group, they talked about the difference between a forbearance and a deferral. Most things that we've been seeing in the forbearance category don't eliminate the obligation of the lender, or I should say the borrower, to pay. What it does is it permits them to tap reserves to keep the loan current. And that was the vast majority of what we've seen over the summer. This deferral seems to be a situation where no P&I has to be made on this property for 12 months. So what was the fallout from that? The fallout was not only did they didn't pay, but the servicer did not advance. Normally, on all CMBS loans, a servicer advances P&I for the life of the loan unless they feel that the value of the collateral has fallen so far that they may not recover their P&I advances. Here,
Which is what we talked about in another educational segment, which was appraisal reductions.
right. So here, no interest payment, no servicer advance. And in fact, this month in the September remittances, the deal that this loan was part of repaid hundreds of thousands of dollars of previous advances back to the servicer. So what did this mean? It meant that for 3 CMBS deals, all 2016 vintages, there were big interest shortfalls this month. The one that we trading alerted on has a $60 million piece of this $140 million loan, which represents about 10% of the collateral pool. The deal is CGCMT 2016 C2. And for that loan, interest shortfalls this month reached up to the AS class, which is AAA rated by 2 rating agencies.
The lowest AAA rated tranche, right?
It is the subordinated AAA. So it doesn't have the same credit enhancement as what used to be called super seniors. Yeah. But it is meaningful that this AAA class has an interest shortfall. And because of this deferral, these interest shortfalls may continue for a considerable period of time, for 12 months, because this loan is so big. Even more interesting, there are 2 $40 million pieces. Because the pieces aren't as big, the interest shortfalls for those CMBS deals only reached up to the C class, which would be your single A class. So for those 2 deals, one of which is JPM 2016 JP3 and CGCMT 2016 P5, those deals saw interest shortfalls up to class C, the single A rated piece. So going back or peeling back one more level of the onion, that second deal, CGCMT 2016 P5, is part of CMBX 10. So because the single A and triple B minus classes and double B classes of that deal had interest shortfalls this month, that's a trigger. Whoever is long those particular indices, CMBX 10, single A, triple B minus, or double B, has to write a check this month to cover the interest shortfall for those that have bought protection. Mm-hmm. So in the past, we've talked about how CMBX works and how you're getting insurance on this. This is the first time I can recall seeing any of the CMBX post-crisis indices, have an event like this. So that's kind of for those who someday want to go on, the CMBS version of Jeopardy, which they do every week, it comes out right after the collegiate, championship of Jeopardy.
And after the teachers tournament,
Right.
and the kids tournament.
Right. They usually run it, the week between Christmas and New Year's. If you go on CMBS Jeopardy, you'll definitely want to have this on your index card.
So let's turn to CLOs. We had a number of news items this week we wanted to highlight.
Yes, there were some interesting news items and some items from our own data. For those that don't know, we have virtually the entire CLO database modeled and databased in our system. So we are constantly looking at trading data for people that are moving in and out of CLO positions and where distressed credits are trading for and who's buying and selling and so forth. So we reference that data frequently, and it does inform our CLO Wire, which is a separate offering that we have every day. 3 quick points. One is that spreads have been narrowing the last couple of days. We saw a nice rally in AAA spreads. The financial planning website did a nice job of pointing this out, talking about how new AAA issues are now coming in at LIBOR plus 130 or less, which means there's appetite for that product, and issuers are able to, place bonds at levels that are pretty competitive right now, nicely low costing, because the AAA makes up the biggest slug of their financing costs. We did a story of Delta getting creative again. They're looking to borrow $6.5 billion, backed by their frequent flyer program. Earlier this year, the firm shored up its credit line by pledging its aircraft and certain routes as collateral. So
explain this to me. How is it that my measly 25,000 miles in Delta Rewards miles can be collateral? Like, isn't that something like, it's almost like it's like Delta's liability.
You would think, and that's the first way I looked at it. I think it's the fact that they're all tied to credit cards and they get a recurring stream of revenue from the credit card issuer for how much is spent and, what the balance outstanding is on that. And I think it's meaningful for these airlines.
Yeah.
That would be my 2 cents, but I don't know if I'm being punked here or what it is, but Joe keeps asking me questions for which I have no real answer for. So
those are the best kind.
So my last one was Chuck E. Cheese. We've written about them several times. They have a $750 million term loan. It's been in the discount bucket for some time. The price is around 60 cents on the dollar, LIBOR plus 650. It got debtor in possession financing of $200 million to get it through its bankruptcy process. But the story that really caught my attention is that they went back to a Texas bankruptcy court asking permission to destroy 7 billion Chuck E. Cheese prize tickets. It's enough to fill 65 40-foot cargo containers. The cost of shredding is $2.3 million. That's why they needed the bankruptcy court's approval. And the estimated value of the tickets is $1 million. So they're spending 2.3 to shred something with a street value, if you will, of $1 million. Each one of these tickets is worth a tenth of a penny, give or take. But they're worried that if the tickets got into the wrong hands, think of that for a minute. If the Chuck E. Cheese tickets got into the wrong hands, somebody could come to them with a claim for $9 million of inventory.
Of rewards.
Yeah, that's a lot of rubber snakes.
That's a lot of plastic roaches and finger handcuffs. And if those got into the wrong hands, there's no telling how much havoc could be wrought in America. So with that,
wow,
nothing like operating a cesspool of kid germs and ball pits in coronavirus times.
On the other hand, if you want to look at this in a positive way, how happy would you be if the local pusher was pushing, Chuck E. Cheese tickets and not something more
Nefarious.
nefarious. Yeah. Right. We'd all be living in a kindler, gentler society.
Rubber snakes for everyone.
That's right.
And the holidays are going to look vastly different in retail this year in many ways. And Macy's announced this week that its Thanksgiving Day parade is online, and visiting Santa at the mall will likely be completely nixed given the focus on social distancing. I'm not sure what else is in store.
Well, I'm going to go on Amazon and I'm going to purchase the most recent Oscar de la Renta handbag for my wife. I'm also going to Uber Eats, I'm going to TaskRabbit a Santa Claus to come to my house. He can sit outside, and my son and I will sit 6.5 feet away from him, and my son will tell him what he wants for Christmas. And maybe I'll charge the neighbors for them to come over and talk to Santa. And if I charge them 50% of what they charge at the Westchester Mall, I might make $100,000.
All I know is that if you're going to call it a virtual parade, I want to see a virtual Zoom with those 12 sousaphone players from the North Bergen High School marching on treadmills. So it's the real thing. I just don't want to hear background music. I want to hear the guy with the sousaphone on a treadmill, playing, jingle bells.
I want to see him emptying that spit valve.
On that note, we'll close. Thanks to our producer, Keegan St. Ange from a remote location. Join us next week as we look at what's happened during the week and how it has impacted you. If you have a question, a comment, or just want to say hi to us, send us an email at podcast@trepp.com. For more info, visit trepp.com and subscribe to the Treppwire podcast with your favorite provider. Thank you, as always, for listening, and stay well.
All right.